Building your ETF portfolio. Key categories to consider. Now let's get concrete. What would an actual ETF-based portfolio look like for someone 50 to 65? It likely involves a mix of ETF categories to cover different bases. A bit of broad market, some growth, some income, maybe real estate. The exact mix depends on your risk tolerance and whether you're closer to 50 or 65. More on allocation by age soon. But here are 5 ETF categories that can form the foundation of a strong portfolio, with examples of each. Remember, these are examples, not recommendations to go out and buy. Always do your own research. We'll show a sample combo later, including specific ticker examples like VOO, SCHG, SCHD, JEPI, etc., to illustrate one possible strategy. 1. Foundational Broad Market ETFs. These are ETFs that give you exposure to a huge portion of the stock market, serving as the core of your portfolio. The classic example is an S&P 500 index ETF, like Vanguard S&P 500 ETF, VOO, or SPY, or IVV. Buy one of these, and you effectively own the market. 500 of America's largest companies across all major industries. The S&P 500 historically has provided solid growth, about 10% per year on average before inflation, and is considered a benchmark for U.S. stock performance. Another foundational ETF could be a total stock market ETF, like VTI, which includes not just large caps but mid and small companies too, even broader diversification. Why include this? It's your stable growth engine and baseline. It's diversified, relatively low risk, as low as stock investing gets, since it's the whole market, and low cost. You can feel confident that if the economy grows over time, so will this portion of your portfolio. Example: VOO, Vanguard S&P 500 ETF, gives you Apple to Amazon, Exxon to Walmart, all in one fund. Typically, a substantial chunk, often 40 to 50% or more, of a portfolio could be in such broad funds when you're in your 50s, then maybe slightly less in your 60s if you're adding more income funds. 2. Growth stock ETFs. These funds tilt toward the high-growth segment of the market. They might track something like the Russell 1000 Growth Index or NASDAQ 100. They'll hold companies that are expanding earnings, revenues quickly, often tech or innovative firms. Examples: SCHG, Schwab U.S. Large Cap Growth, or VUG, Vanguard Growth ETF, or the famous QQQ, NASDAQ 100, which has a lot of big tech names. Why include this? This is to potentially boost your portfolio's growth rate. Since you're starting late, a bit of extra growth can help make up for lost time, as long as you're comfortable with more volatility. Growth ETFs can swing more year to year, up big, but also down big. They carry more short-term risk, so you wouldn't want this to be the majority of your portfolio if you have a low risk tolerance or are very close to retirement. But a reasonable allocation, say 10 to 20%, in your early 50s can goose your overall returns. By your mid-60s, you might reduce the percentage here to protect against big swings. Example: Schwab SCHG holds companies like Microsoft, Google, Visa, firms with high growth metrics. Over the last decade, growth ETFs outperformed broad market, but remember, past performance isn't guaranteed. 3. Dividend and value ETFs. These are the income-focused stock funds. They invest in companies that pay regular dividends, often referred to as value stocks. Established, stable companies valued for their steady returns rather than flashy growth. Examples: SCHD, Schwab U.S. Dividend Equity, VYM, Vanguard High Dividend Yield, or DGRO, iShares Dividend Growth. These ETFs typically yield perhaps 3% annually in dividends, give or take, and focus on companies with a track record of raising dividends or high current yields. Why include this? For the steady income and lower volatility. As you inch closer to retirement, you'll appreciate having a portion of your portfolio that generates cash and isn't as volatile as growth stocks. Dividend ETFs focus on stable, dividend-paying companies and are generally less volatile than the overall market. They tend to drop less in bad markets, but they can still drop. If you reinvest dividends now, these contribute to growth. Later, you can switch to taking the dividends for spending money. Example: SCHD is beloved by many investors for its strong portfolio of quality dividend stocks and has had competitive returns with the S&P 500, all while yielding approximately 3% and growing its dividend over time. 4. High yield and income specialty ETFs. This category is optional but can be a nice kicker for income. These include ETFs like JEPI we discussed, or others like covered call ETFs, e.g. QYLD, XYLD that write options on NASDAQ or S&P 500 for income, or even high-yield bond ETFs, which invest in lower-grade corporate bonds for higher interest. The goal here is to produce a significantly higher yield, sometimes 7 to 10%. Why include? To boost your current income. Useful if you are nearing retirement or want to accelerate growth by reinvesting a high yield. Caution: these often involve trade-offs like limited upside or higher risk. For instance, a covered call ETF like JEPI or QYLD will pay a big yield but won't climb as much in a bull market. A high-yield junk bond ETF will pay more interest but can drop in value if the economy falters, since those bonds can default. So, use in moderation. Example: JEPI for equity income, or HYG, iShares. High Yield Corp Bond ETF for high-yield bonds. Including maybe 10% of your portfolio in such funds during your 60s could provide extra income, but you might avoid them entirely in your 50s if you're focusing on growth. It's a tool in the toolkit, not a must-have. 5. REIT, real estate. ETFs. As discussed, these funds give you exposure to real estate. Example: VNQ, Vanguard. Real Estate ETF, or SCHH, Schwab US REIT. They usually yield above-average dividends because real estate companies pay out rents collected. Why include? Diversification and income. Real estate often doesn't move in lockstep with the stock market, so it can be a good diversifier. Plus, REIT ETFs offer higher dividend yields than many stock funds. VNQ has often yielded approximately 3 to 4% historically. They also provide a hedge against inflation to some extent. Rents and property values tend to rise with inflation. If you're 50, maybe you put about 10% in REITs. At 65, you might keep a similar allocation since they provide income. Just be aware, in a rising interest rate environment, REIT prices can drop, since financing costs rise and yield-seeking investors may prefer bonds. So they're not immune to risk, but over long periods, real estate has been a solid asset class. That's your palette of ETFs. The exact percentages and choices can be tailored. Next, let's see an example of a personal ETF strategy using 4 specific ETFs, just to make this super concrete. To illustrate how someone might put all this together, let's walk through an example portfolio for, say, a 55-year-old investor named Alice. Alice wants a balanced approach that will grow her money but also start generating some income as she gets closer to 65. She decides on 4 ETFs to cover different bases. This example is for education only. This is not a specific recommendation to go buy these, but they are common choices that will help you understand the strategy. Our 4 funds will be VOO, SCHG, SCHD, and JEPI. Each plays a role. 1. VOO, Vanguard S&P 500 ETF. This is Alice's foundation, making up, say, 40% of her portfolio. It gives broad market growth and diversification. Low cost, reliable long-term growth, roughly matching the U.S. stock market. Whenever she buys VOO, she's effectively buying a slice of everything, from Apple to Zillow. Okay, maybe not Zillow, but you get the idea. This is the haystack. If she does nothing else, VOO alone could be a fine one-fund solution. We add other funds to complement it. 2. SCHG, Schwab US Large Cap Growth ETF. This is the growth booster, perhaps 20% of the portfolio. It tilts toward tech and high-growth companies. It holds a lot of the growth half of the S&P 500. By including SCHG, Alice is trying to capture extra upside. This fund will likely be more volatile. In a year where tech stocks soar, SCHG will shine. In a crash, SCHG might fall more than VUO. But at 20%, it won't derail her, and over 10 years, it could add some oomph to her results. 3. SCHD, Schwab US Dividend Equity ETF. This is the dividend income and value slice, maybe another 20% of the portfolio. SCHD holds about 100 high-quality dividend-paying U.S. stocks. It's known for a 3 to 4% yield in stocks with strong fundamentals. By holding SCHD, Alice starts building an income stream. She enrolls in DRIP to reinvest those dividends for now. SCHD also historically has been less volatile than the overall market, cushioning the portfolio during downturns. In 2020's crash, or 2022's bear, SCHD held up relatively well. This gives her portfolio some stability and cash flow. 4. JEPI, JP Morgan Equity Premium Income, ETF. This is the high-yield income component, making up the final 20%. JEPI, as we mentioned, uses an option strategy to generate a high monthly dividend. Its yield is often around 7 to 9%. For Alice, JEPI serves two purposes: generate extra income, which she's currently reinvesting to grow her balance faster, and reduce volatility. Interestingly, JEPI tends to be less volatile than the market. It often doesn't drop as much in bad times because the option's income buffers it. The trade-off is it also doesn't climb as much in huge rallies. By having 20% in JEPI, Alice's portfolio is getting a steady drip of cash, which she uses to buy more shares. Over 10 years, if she reinvests JEPI's big dividends, this chunk can compound nicely. When she retires, she might turn off DRIP and use JEPI's monthly payouts as a paycheck. Now, how does this mix work together? In good market years, VOO and SCHG will likely drive growth. SCHD will chug along, and JEPI will lag a bit in total return because of capped upside. In bad market years, SCHD and JEPI will hold up better, plus JEPI's income keeps coming in, cushioning VOO and SCHG's losses. The overall portfolio is diversified across growth and value, broad market and specialty income. It's a balanced diet of ETFs. Alice plans to rebalance annually, meaning if one fund grows to much more than its target percent or another shrinks, she'll add or trim to get back to her 40-20-20-20 ratio. Most of the time, she can rebalance by directing new contributions rather than selling. For example, if SCHG soared and became 25%, maybe for a few months she buys more of the others instead of SCHG. Important: this specific mix is just one of many valid approaches. Some might argue for including international stocks, or some bonds for safety, etc. Alice chose no bonds because she feels with 10 years to go, she wants full growth and income from equities, and JEPI kind of mimics a bond alternative with its income. Someone else might be more conservative and include a bond ETF. That's fine. You can tweak as per comfort. The big picture is diversification and alignment with goals. Alice's example shows how to combine ETFs to achieve that. And once more for the people in the back. This is not a recommendation to blindly copy. It's an illustration. Always do your own due diligence on any fund, what it holds, fees, risks, or talk to a professional. Our goal is to make these concepts concrete, not to tell you these four are the best or only options. All right, we have our strategy and tools. But how do we actually get the money to invest every month? This is where budgeting comes in. Since you're starting late, it's crucial to free up as much money as you reasonably can to contribute towards your retirement investments. A popular guideline that might help is the 70-20-10 budget rule. 70% of your take-home income for living expenses, all the necessities and even discretionary spending. At this stage of life, your needs might include supporting family, medical costs, etc. So 70% is a guideline. Some may need a bit more here, some less. 20% of your income for savings and debt repayment. This includes building an emergency fund, paying extra on any high-interest debt, and saving for short-term goals. If you have credit card debt or other high-interest loans, use part of this 20% to pay those down aggressively. You can't get ahead if you're paying 18% interest to a card company. Clearing high-interest debt is the best investment. The SEC notes, nothing beats paying off high-interest debt as a risk-free return. Once debts are paid and emergency fund is in place, this 20% can also slide over to investments. 10% of your income for investments and/or donations. This is the slice specifically earmarked to invest for your future and/or charitable giving if that's important to you. Using 70-20-10 can be a great start. For example, if your take-home net income is $4,000 a month, the rule suggests trying to invest $400, 10%, per month. However, here's an honest note. Starting late means you might want to aim higher than 10% if possible. There's nothing magic about 10%. If you can trim the 70% living expenses down, or if you've paid off debts, redirect more to investing. Many late starters try to do 20% or even more into investments once they get serious, especially if retirement is, say, only 10 to 15 years away. It might require lifestyle adjustments, downsizing home, cutting optional costs, even picking up a side income temporarily. But remember, this phase of sacrifice is so that your 60s and 70s can be more comfortable. Every extra dollar you invest now will help fill the gap in your savings. If 10% is all you can do now, start there. You can always increase it later. For example, if you get a raise, funnel half of it to investments. The key is to treat investing like a non-negotiable bill. Automate that transfer into your IRA or brokerage each month so you pay yourself first before you find other ways to spend it. Fractional shares. No amount is too small. You might worry, what if my 10% is just $200 a month? Some ETF shares cost $300 plus. I can't even buy one share. Fear not. Fractional share investing has you covered. Most major brokerage platforms, Fidelity, Schwab, Robinhood, etc., now allow you to buy partial shares of ETFs. That means if you have $50, you can still invest $50 worth of VOO, or any stock and ETF, even if one full share costs more. A fractional share is simply owning less than one full share of a stock or other security. It's a fantastic development for investors starting with small amounts. You are not locked out of expensive stocks and ETFs just because you can't afford a whole share. For instance, Amazon stock trades for thousands of dollars per share. But with fractional shares, $100 can buy you 1/20th of a share. Same with ETFs. Want to invest in an ETF at $250 per share but only have $100? You'll get 0.4 shares. It grows the same percentage-wise. Investor.gov, the SEC site, emphasizes that fractional shares are a way to invest when you do not have enough money to purchase a full share. So no excuses like, I'll wait until I have X dollars saved to start. Start now with whatever you have and keep adding. Fractional investing plus no commission trading, most brokers don't charge trading fees anymore, means even $5 can be invested efficiently. In our example, Alice could set her contributions to automatically buy $200 of VOO, $100 of SCHG, $100 of SCHD, $100 of JEPI each month. Even if that buys odd decimals of shares, it doesn't matter. It all adds up. Choosing a brokerage or account. To implement your plan, you'll need an account to invest in. For retirement goals, a Roth IRA is often ideal if you're eligible. More on eligibility in a second. Roth IRA means you contribute post-tax money. No tax deduction now, unlike a traditional IRA. But then all future growth and withdrawals are tax-free after age 59 and a half. That's a huge benefit. especially if you expect taxes to be higher in the future or if you want to minimize taxes on your investment earnings. With a Roth, any dividends, capital gains, etc., grow tax-free. At withdrawal, you owe nothing on gains as long as you follow the rules. Considering you're starting a bit late, using a Roth IRA can ensure that whatever amount you do accumulate, you keep 100% in retirement, as opposed to owing some to Uncle Sam, which is the case with 401ks or traditional IRAs where withdrawals are taxable. For 2025, you can contribute up to $7,000 per year to an IRA plus $1,000 catch-up if you're 50 plus, so $8,000 total. That's about $667 per month. If you can swing that, do it. It maximizes the tax-advantaged space. If you're married and your spouse has little or no income, consider a spousal Roth IRA as well. And if you have a workplace retirement plan like a 401k, definitely contribute to that too, especially up to any employer match. Free money you don't want to miss. The focus here is on personal investing with ETFs, but certainly take advantage of all retirement plans available to you. Whether Roth IRA or regular brokerage, taxable account, or 401k, the ETF choices we discussed are available in all those accounts. The main difference is taxes. If you invest in a taxable account, be aware dividends will be taxable each year, unless it's Roth or traditional IRA, where they aren't. Given our audience, a self-directed Roth IRA might be the way to go. Self-directed just means you open an IRA at a brokerage of your choice and you pick the investments, ETFs in this case, as opposed to, say, a company pension where they manage it for you. It gives you control. The IRS imposes income limits on Roth IRA contributions. If you're high income, you may have to do a backdoor Roth. But many folks near retirement who are starting late are within the limits to contribute. Check the IRS guidelines or with a tax advisor to be sure. Brokerage suggestions. You'll want to choose a brokerage firm or platform to host your account. Look for one with low fees, good customer service, and the features you need, like fractional shares and automatic investment capabilities. Major reputable brokers in the U.S. include Fidelity, Charles Schwab, Vanguard, TD Ameritrade, E-Trade, among others. Many fintech apps, Robinhood, M1 Finance, etc., offer ease of use as well, but since our audience is 50 to 65, you might value a company with robust support and decades of trust. There's no one-size-fits-all. Any well-known broker will give you access to the ETFs we discussed. Just make sure they are SIPC insured, which all the major ones are, and have reasonable trading interfaces. Since most are zero commission now, cost isn't a big differentiator. You might base your choice on user-friendliness or specific features. For example, Fidelity and Schwab both offer fractional shares and let you set up automatic investments into ETFs. If you prefer a human touch, some firms have local offices or advisors you can consult, though that might come with fees. For pure DIY, an online account is fine. Opening an account is straightforward. You can usually do it online in 10 to 20 minutes. Have your identification and bank info ready to link for transfers. Monthly contribution guidelines by age. Let's talk numbers. How much might you need to contribute each month to reach a decent retirement fund, starting from scratch at, say, 50, 55, 60? This will vary wildly based on individual circumstances, but we can give some ballpark scenarios. Assume for these scenarios an average annual return of approximately 6 to 7%. A balanced portfolio might do that. We'll also assume retirement at 65. Here are example targets. Starting at age 50, you have 15 years to save. If you contribute around $500 per month and earn approximately 6% annually, by age 65, you could accumulate roughly $145,000. For context, $500 per month is 12% of a $50,000 salary, or 6% of a $100,000 salary, so depending on income, it might be feasible to do more. If you could contribute $800 per month, you'd get closer to $230,000. And if you maxed a Roth IRA at $667 per month, $8,000 per year, you'd land around $180,000. These are rough numbers, but it shows that even a few hundred a month can build a six-figure sum in 15 years. Combine that with Social Security, and you've got something to work with. Lesson: at 50, try to contribute at least 10 to 20% of your income. Use pay raises, debt payoffs, or kids moving out as opportunities to ramp up savings. Also take advantage of catch-up contributions. Being 50 plus, you can put more into retirement accounts, like $7,500 extra into a 401k. If your employer allows, max that out to really turbocharge your savings. Starting at age 55, you have about 10 years. The math isn't as generous, but not hopeless. At 6% growth, $500 per month for 10 years becomes around $82,000. If you can manage $1,000 a month, that doubles to approximately $164,000. So to break the $100,000 mark in a decade, you're looking at roughly $600 to $700 per month invested. That might sound steep, but perhaps your mortgage is nearly paid or kids are through college by mid-50s, freeing up cash. If not, look for areas to trim or ways to earn a bit extra. Remember, Social Security will also be there. The average benefit for a retired worker is around $1,500 to $2,000 per month currently. And every $100,000 of investments could potentially provide maybe $300 to $400 per month in sustainable withdrawals, using a approximately 4% safe withdrawal rule. So it all adds up. Starting at age 60, only 5 years to 65. This is crunch time. $500 per month for 5 years is about $35,000 accumulated. To get to, say, $70,000, you'd need approximately $1,000 per month. If that seems impossible on your income, consider that many at 60 plan to work a bit longer, maybe to 67 or 70. If you can extend the timeline, the numbers improve with each extra year of contributions and compounding. Also, after 60, catch-up limits rise further for some accounts. 401k catch-up becomes even larger at 60 to 63. So if you're 60 with no savings, it might be time for a serious budget overhaul or downsizing to free up as much as you can. It might also mean adjusting expectations. You may not retire at 65 with full financial independence, but maybe you save enough by 65 to partially retire or have a safety cushion, and you work part-time a few more years. And that's okay. Many people are working into their late 60s now, especially if they started saving late. The goal is to ensure you have some savings to supplement Social Security so you're not solely relying on it. The big message is start now and contribute consistently. Even if the amounts feel small, they matter. One analysis showed that $100 a month starting at 50 grew to about $28,600 by 65 at a 6% return. Now, $28,000 alone isn't life-changing, but it's infinitely more than $0 if you never started. And most can manage more than $100 per month with commitment. So never dismiss even modest contributions. It all counts. We've touched on this, but let's explicitly address ETF allocation by age. The closer you get to retirement, the more your focus might shift from growth to preservation and income. A common guideline is to gradually reduce risk as you age. For example, the old rule of thumb, 100 minus your age equals percent in stocks, is a rough idea. So at 60, 40% in bonds or safer assets, 60% in stocks. However, with folks living longer and bonds yielding low in recent years, many adjust that to 110 minus age, or similar. In ETF terms, since our plan is mostly stock ETFs, one might incorporate some bonds or increase the income ETFs as they approach 65 plus. In your 50s, you likely still want a decent chunk in growth. You have time for it to recover if the market dips. So maybe you keep approximately 70% in stock ETFs, broad and growth, and 30% in dividend or income, or REIT ETFs, which are still stocks but more value-oriented and stable. You might not bother with bond ETFs yet, especially if you have a strong stomach, and the income ETFs like JEPI are playing a quasi-bond role. The Thrivent advice earlier put it well. If you're in your 50s or 60s and still working, you aren't too late. You'll still have time to earn compound returns. though you'll probably want your asset allocation to be more conservative than when you were younger. This means as you move through the 60 to 65 range, you start dialing down the high-risk stuff. By your 60s, especially mid-60s, you might flip the earlier ratio, perhaps only about 40 to 50% in pure growth stocks and broad market, and about 50 to 60% in income-oriented and safer funds. This could include some bond ETFs or cash as well for stability. For example, at 65, someone might hold 50% broad market, still need growth for a possibly 20-plus year retirement, 20% dividend stocks, 15% REITs, 15% high yield, or cash or bonds. There's no one formula, but the principle is shift to preservation gradually. The last thing you want is to hit 64, have 100% in aggressive stocks, and a market crash wipes out 30% of your portfolio right when you plan to retire. By easing into a more balanced stance, you protect against that scenario. Also, consider when you'll tap the money. If you retire at 65 but won't need to draw heavily until 67, maybe you delay Social Security to get a higher benefit and use investments in the interim. That money for 2 years should be in relatively safe assets, like short-term bond ETFs or cash. If part of your investments is for later retirement, like you plan to use some at 75 plus, that portion can stay in growth longer. Some retirees bucket their funds by when they'll need them. Near-term bucket, 0 to 5 years, in safe stuff. Medium, 5 to 15 years, balanced. Long-term, 15-plus years, or legacy, in growth. As a late starter, your portfolio may not be huge, so a simpler approach is fine. Just avoid being too aggressive near the end of your working years. One more allocation tweak. Keep an emergency fund, at least 6 months of expenses in cash or safe account. Separate from investments. This prevents you from having to dip into investments at a bad time. Also, if you're still carrying any high-interest debt in your 50s, prioritize paying that down. It's like a guaranteed return equal to the interest rate. For example, paying off a 15% credit card is a huge win. Let's end with a bit of motivation and hope. I want to paint a picture of two fictional 60-year-olds to show why starting now, even with small amounts, is so important. Meet Alice and Bob. Both are 60 and have no retirement savings today. Alice watches this video, hi Alice, and decides, I'm going to do this. Bob, on the other hand, shrugs and says, hey, too late for me. Why bother? I'll just hope Social Security is enough. Alice tightens her budget and manages to invest $500 per month from age 60 to 67. She chooses to work until 67 to maximize Social Security. She puts it in a balanced ETF portfolio and earns, say, approximately 6% a year on average. Fast forward to age 67. Alice has contributed $500 times 12 times 7 equals $42,000 of her own money. With growth, her nest egg has grown to about $60,000 plus by 67. Not a huge amount, but certainly a welcome supplement. That $60,000 could provide an extra $200 to $250 a month if she withdraws conservatively for the rest of her life. It could cover her Medicare premiums or allow for some travel each year, or give her a cushion for emergencies. Plus, she has the satisfaction of achievement. She took control and now has options. Bob, meanwhile, at 67, still has $0 in investments. He solely relies on Social Security. Each month, he has just his check, which covers the basics but not much else. If an unexpected expense comes, he has to scrape by or go into debt. He may have to lean on family or cut back his standard of living significantly. At 70, Alice's investments, if untouched and still growing, might be $75,000 plus. Bob's is $0. At 75, Alice maybe has drawn some of it, but still sees a balance that can cover healthcare costs or allow her to enjoy life. Bob is regretting not starting when he was 60. Now, let's imagine an even starker contrast. Charlie is 55 with no savings and decides to invest for 10 years, while Dave is 55 and does nothing. Charlie manages $800 a month for 10 years, 55 to 65. At approximately 6% growth, Charlie ends up with around $110,000 to $120,000 by 65. Dave, of course, ends with $0. Charlie's $120,000 could generate roughly $5,000 per year in passive income, 4% withdrawal, which might cover a lot of yearly grocery bills or allow a few nice vacations, etc. Or if Charlie doesn't need it at 65, he can let it keep growing. Meanwhile, Dave has to either keep working or drastically reduce expenses, and any unexpected need is stressful. The point is, the difference between starting and not starting is huge, even if you never reach millions. As one financial proverb goes, do not let the perfect be the enemy of the good. Would it have been ideal to start at 25? Sure, then you might have millions by now. But you didn't. Dwelling on that won't help. What will help is taking action at 50, 60, or whatever age you are now. It's amazing what consistent saving even for a decade can do. And aside from the money, there's a psychological benefit. You'll feel more in control and optimistic about the future. You transform from feeling like a victim of circumstances to an active planner of your retirement. Honest talk. If you're 60 plus and your savings end up, say, $50,000 by retirement, you're not retiring in luxury. We're not here to pitch dream scenarios. But that $50,000 could be the difference between making ends meet and struggling. It could fund crucial home repairs when needed, pay for better health care, or allow you to live in a slightly nicer area. And if you're 50 or 55, you have enough runway to possibly accumulate a few $100,000, which is significant. Every bit will improve your financial security and dignity in retirement. Also, consider this. By starting to invest, you might actually enjoy it and find momentum. Many late starters tell us that once they saw their balances growing, they became motivated to save even more, find extra income, etc. It can be empowering. You might find at 55 that you're able to semi-retire at 65 with a part-time job and your investments, rather than working full-time into your 70s. That's a win. So, be like Alice, not Bob. Start writing your own comeback story today. It's never too late to improve your finances. Even small steps can lead to big changes over time. You've made it through a lot of information, so give yourself a pat on the back. We covered mindset, what ETFs are and why they're great, how to use them for growth and income, what kinds to consider, a sample portfolio, budgeting and saving strategies, and a dose of motivation. Now it boils down to taking action. 1. Make a plan. Determine how much you can invest each month. Use the 70-20-10 rule or your own budgeting method to carve out that investing money. Set a goal, even if it's modest at first. 2. Open an account. If you don't have a Roth IRA or brokerage account, choose a platform and get started. It might take a week or two to get everything set up and linked with your bank, so start that process. 3. Pick your investment mix. Decide on a simple ETF portfolio that you're comfortable with. It could be as basic as one target date retirement fund or a balanced fund if you don't want to juggle multiple ETFs, or use a 2 to 4 ETF combo like we illustrated. The exact one isn't as crucial as just getting invested in a diversified way. If in doubt, an S&P 500 fund plus a dividend fund is a reasonable 2-fund starter combo. 4. Automate contributions. Set up that monthly auto deposit and auto invest, if available, so that every month your plan executes. Treat it like a bill. 5. Reevaluate annually. Life changes, incomes change. Try to increase your contributions over time, e.g., each year upping by 1% of income, especially if you're still not on track for what you'll need. Also adjust your portfolio as you age, perhaps shifting a bit more conservative as you get within 5 years of retirement. 6. Stay the course. Markets will fluctuate. You may see your balance drop during a recession. Don't let that derail you. Remember, you're in it for the long haul. Even if long is 10 to 15 years for you, that's still enough time to see cycles. Keep dollar cost averaging through the storms. In fact, downturns are when your DCA is buying low. You'll be grateful later. 7. Consult help if needed. If you're unsure, consider talking to a fiduciary financial advisor. even just for a one-time planning session to get personalized input. And certainly involve your spouse or family in the conversation so everyone's on the same page with goals and expectations. Finally, keep learning and stay inspired. Late investing doesn't have to be drudgery. It can be exciting as you watch your progress. Celebrate milestones. First $10,000 saved, then $50,000, etc. It might not be viral YouTube content, but it's something to be proud of. We'll leave you with that recurring quote to remember. Don't look for that one needle in the haystack, just buy the entire haystack. By investing in broad funds, the haystack, and consistently adding to them, you're giving yourself the best chance at catching all the good needles in the market. The future needles of success, new booming companies, rising markets, will be yours as a bonus for embracing the haystack approach. Thank you for watching. Remember, it's never too late to take charge of your financial future. Every day is a new opportunity to make things better. If you found this helpful, please give it a thumbs up and share it with others who might be starting late on their investing journey. Check the video description for links to resources, including the book Faith and Financial Fortune by Leroy L. Deal. It's available via Epiphany Publishing House and on Amazon. We've provided the links for you. That book dives deeper into principles of building wealth at any stage of life and might resonate with those of you who like a blend of financial and inspirational guidance. Lastly, keep in mind this video is educational. Consult a certified professional for personalized advice and never give up on yourself. You've got this. Here's to planting those seeds, growing your haystack of wealth, and enjoying a stable, secure retirement. Happy investing, and until next time, take care of your financial future one step at a time.